Welcome to ORE's second lesson. In this tutorial, I will be teaching you the basics of options trading. We'll be looking at the strike rate, expiry date, and deal size for put and call options. Don't forget, you can practice trading with a free demo account at optionsareasy.com. In the first lesson, we used the new mode to trade options. Now we're going to move up a level. From the new mode, click the link in the bottom left, Create My Own Trade. So here is the basic mode, and you can see it looks a bit different. You can now tailor a trade to your exact market outlook and your investment size. Because now not only can you choose the pair you want to trade and the type of option, either a put or a call, but you can also choose the strike rate, the expiry date, and the amount. This gives you tremendous flexibility and a lot more investment power. So let's take a look at these parameters and how they affect the trade. First, you can monitor the market rate of the pair from the top bar. Here we have euro-dollar trading around 1.1360. Then on the actual trade, you can select the pair you want to trade. You can choose from over 20 currency pairs, gold, silver, and WTI crude oil. The next box along is the option type. You would choose a call if you expect the market to rise, and a put if you expect the market to fall. The following box is the strike rate. Remember that the strike is the rate you are reserving in the market. For a call option, it's a buy reserve rate, and for a put, it's a sell reserve rate. The default here is 0%. That just means it matches the current market rate. It is 0% from market. You can also enter the strike rate as a number by clicking in the box and typing in a rate. Now the strike's level determines the cost to buy the option. You can see here at a strike of 155.20, the option will cost $49 US. But if I entered a worse rate, say I buy at 156, then you can see now that the option's cost to buy has gone down to $19. So you can see that an option with a worse strike rate is cheaper. However, the market has to move further, in this case above 156, for you to receive a payout by expiry. When an option strike is worse than the current market rate, we say that the option is out of the money. These types of trades, an out of the money option, is useful for when you want to reduce your risk and when you expect a large market move. The next box along is the expiry of the option trade. If you click in the box, you can choose any date from as low as 1 day all the way up to around 200 days. So how does expiry affect the cost to buy an option? An option with a longer expiry is more expensive. You can see here that the expiry of 198 days for the 11th of September would cost me $363 US. Yet if I change the expiry to just 1 day, the cost of the option has been reduced to just $9. This makes sense because the more time you have until expiry, the higher the chance that the market will move in your favor. This could be described as buying more time. Now the last box here is the amount. You know that an option is used to reserve a rate in the market over a certain period of time for a certain amount. Here the amount is given in the first currency of the pair. In this case, that's 10,000 British pounds. The amount you enter has a direct effect on the cost of the option. The larger the amount, the more the option costs, and the higher the potential payout. If you click in the amount box, you can change this amount. You can trade as little as 5,000, and you can see that would make the option a cost of just $4.82, all the way up to 5 million. And in this case, the option now costs $4,800. But for the purpose of this example, let me stick with the smaller amount of 10,000. So in summary, the option we have here is a call with a reserve rate to buy £10,000 against the US dollar at 156 over the next day, and this will cost me $9, or in my own domestic currency, that is £6. To view the payout potential of this trade, you click the Scenarios button. This is the same chart and table that you saw in Lesson 1. It shows the payout over a range of market rates. You can see that as sterling to US dollar rises, the payout also rises. And if in the next day sterling US dollar reached 156.48, the top point of the chart here, I will receive a profit. If you refer to the table underneath, I'll receive a profit of $38, 4 times more than the initial investment size of $9 I put down. And of course, if I'm wrong and sterling dollar falls, I will in fact make a loss, and that loss is limited. Now, an important point to note is that an option is always worth more before its expiry. And the chart we're looking at the moment is the payout at expiry, and therefore this is the lowest payout you will receive. If the market moves in your favor before expiry, the payout will be higher. You can analyze this by clicking the Present Payout button on the chart. This gives you an indication of what the payout will be if the market moved today. You can see that the payout line is now a lot smoother and higher than the payout at expiry. Now don't worry if you're not following all of this for now, as I will be covering the payout scenarios in Lesson 3. So once you're happy with your evaluation, you can close this chart and you can buy the option by clicking Trade Now. The trade will appear in your open positions. You can see all of the trade details, the strike rate, the amount, the expiry date, the premium at open, which is the amount you paid for the option, and the premium now, which is how much the option is worth at the moment. And obviously the difference between these two values is your profit or loss. At any point, if you want to go back and analyze the payout again, you can do so by clicking this chart icon. And you can close the trade before expiry by clicking in the box on the left hand side and then clicking Close Selected Positions button. Now let's go back into the trading zone by clicking Add Position. And this time we're going to look at a put option. So I can change the type by clicking in the box and selecting Put. Remember, with a put, I'm reserving the rate to sell. So in the strike box, you would enter a rate that you expected sterling to US dollar to fall below. Let's say, for example, 154. And in the expiry box, I need to select the amount of time I want to give sterling dollar to fall below 154. In this case, let's give it 2 days. And you can see if I leave this option at 10,000, then this will cost me $9. If I were to change that to 1 million, you can see the cost is now 965, and if I choose an amount of 100,000, the cost is just 96. The flexibility on investment size shows just how dynamic an option trade can be. So in summary, this is a put with a reserve rate to sell 100,000 sterling dollar at 154 over the next 2 days, and it will cost me $96 or £62 in my own currency. And if I go to click on the scenarios button, I can see that as sterling dollar falls, I will receive a higher payout. Now I think that's a pretty good trade, so I'll go back to the trading zone and click Trade Now. And here you can see my put option trade above the previous call trade that we opened. Now if I go back into the trade zone by clicking Add Position, you may have noticed in this basic mode of trading, you are restricted to only buying an option and only buying one at a time. In the fourth lesson, we'll be looking at the advanced mode, which allows you to sell or buy options and trade strategies through opening multiple options at the same time. In the next lesson, we'll be looking at payout scenario charts. I will teach you how profit is calculated and how time affects the option's value. If you have any questions, don't hesitate to email us info@ore.com.